evening, everyone. Thank you for joining here. It's a pleasure to have you here, and we would like to take this opportunity to wish everyone a very happy new year. So thank you for joining us at the JP Morgan and StashAway JP Morgan Asset Management and StashAway Market Outlook event. I'm Tiffany from StashAway, and I'll be your moderator for tonight. So before we kickstart officially, let me first introduce our speakers. First of all, we're very happy to have Marcella, who's the global market strategist from JP Morgan Asset Management. She's responsible for formulating and delivering JP Morgan Asset Management's views on the market to investors across Asia. Next, we are very happy to have Michele, who's the co-founder and CEO of StashAway, who joined us from Singapore. So prior to founding StashAway, Michele spent half of his career mainly around financial services, first as a consultant to large financial institutions at McKinsey, and then as a private equity investor. He then spent the second half of his career building consumer internet companies, first as a managing director at Rocket Internet, and then as the group CEO of Solora. Next, we're also very happy to have Stephanie, who's our Chief Investment Officer. She has over 2 decades of experience managing global multi-asset portfolios for Goldman Sachs institutional investors, as well as family offices. Prior to finance, she also started her career as a consultant at McKinsey, and she graduated with a master's in computer science, specializing in artificial intelligence from Stanford University. Finally, we'll also have Ronald, who's our Hong Kong General Manager, share a few words. He's responsible for the overall business development and operations at StashAway Hong Kong. And here's our agenda for tonight. Since most of you here are new to StashAway, we'll first invite Michele to share why he started StashAway, and then we'll pass the time on to Marcella and Stephanie to share the market outlook by JP Morgan Asset Management and StashAway respectively. Then we'll pass the time on to Ronald, who will go through the product suite we have at StashAway Hong Kong, and we'll end with a Q&A session where you can ask anything that we haven't covered. And please also feel free to stay behind for networking. Before I pass the mic to Michele, we would like to invite everyone to scan the QR code. This will take you to our Slido page where you can basically leave any questions that you have throughout the session, and we'll get to them at the end. And you can either scan the QR code or go to slido.com and input SA Hong Kong X JPM AM. And we'll give around 30 seconds for everyone to scan the QR code. And if you see any questions that you like, please also give it an upvote so that it will rise up to the top and we'll get to those questions faster. Okay, I think most of you have got the QR code. So without further ado, I'll pass the time on to Michele to talk about his story of founding StashAway. Thank you, Michele.
Thank you, Tiffany. And thank you. And thanks, everyone, for coming out tonight. As mentioned by Tiffany, my name is Michele Ferrario. I'm the co-founder and CEO of StashAway. First, there is a few people standing in the back. There is a few seats in the front. Feel free to come up. We're nice people, I promise. But up to you to decide. But feel free to walk up any moment. So as mentioned by Tiffany, I thought that given that we have Marcella and Stephanie later talking about the markets, I'll maybe spend a couple of minutes with a complete different angle, just giving you a little bit of the history of StashAway for those of you that might not be familiar with it. So I co-founded StashAway 7 years ago in 2016, together with 2 other people. Nino, who's our CTO, and he's a computer scientist by training. What he's done all of his life is building tech companies. And Freddie, who until a year and a half ago was our chief investment officer, and now sits on our board of directors but does not have operational responsibilities, who is an investor, is an economist by training, and spent more than 2 decades investing institutional money at some of the largest institutions. And Stephanie has been working with him for a few years, and then over the last year and a half took that same responsibility. So a lot of people ask me why did you decide to start StashAway? You are in 2016, an Italian based in Singapore. Why do you start a digital wealth manager? And the answer is that at the time I was 35. Now you can do the math. I'm a bit older, and I was the CEO of a company called Zalora. So I was working fairly long hours. I have a demanding job. I had 2 kids at the time. I now have 3 plus 1 coming. But so I was mid-30s, 2 kids, very busy, starting to save money, started to think about my money seriously, right? So I had 2 kids, I had a family to think about, I had long-term goals. I'm thinking sooner or later I want to stop working. I like for my kids to go to a great university, and so trying to think about what I should be doing with my money. And because I have a background in finance, I had a very clear idea. I wanted to invest on a monthly basis in diversified portfolios using ETFs, which is what I used to do when I had very little money back in Italy, 10 years earlier. And so I went to my 2 banks. I'm not going to name them. I went to the 2 banks I had relationship managers at and told them, hey, I'd like to build a portfolio where I invest every month. And they made it extremely difficult. And they were just trying to sell me mutual funds with entry fees, structured notes with stupid risk rewards profiles. And I was a bit shocked by that experience because it's something that in Europe doesn't happen since 10 years ago and in the US since 25 years ago. And so when I realized that in the US there were digital platforms that made it easy to do what I wanted to do, I learned the term robo-advisor, which I had never heard before. I went on Google and I Googled robo-advisor Singapore because I wanted to find one to invest my own money. And I couldn't find any. And that's what I said, maybe that's what I should be doing. And then so I started looking for partners. I met Nino, who then became the CTO. I met Freddie, who then became a chief investment officer. And when the 3 of us together, we sat in a coffee shop discussing the idea, it was clear to me that it was going to be very difficult for anyone to build such a complementary team. Each of us had 15, 20 years of experience in a relevant field, but very different fields. And so that's how we all took the idea to say, okay, let's do it, let's start. And that's how we started. So now, 7 years later, we're now live in 5 markets. There is a slide there showing you, we started in Singapore, we then launched Malaysia, and then over the last couple of years, we launched here in Thailand and in the UAE, in Dubai. We've done this with the help of obviously many people and a few institutions. So we're backed by Sequoia, we're backed by Fidelity, and we're backed by SquarePeg, which is the largest Australian VC. And obviously we collaborate with a number of institutions to make sure that the flow of money is always safe. So we work with HSBC and Citi as the ultimate custodians for the business. What that means, and I preempt the question I always get, is that people ask me, what happens if StashAway goes bankrupt? And the answer is nothing, meaning that all the money is always separated and is in custodian accounts. We don't have any plan to go bankrupt, and as you can see, there is a lot of interest about what we're trying to do. But the money is always safe and in a custodian structure, which is, by the way, driven also by regulation. We're regulated across all the 5 markets that I mentioned earlier, and in Hong Kong we have a Type 1, Type 4, and Type 9 license. So I don't want to take too long. I just wanted to give you a glimpse over how StashAway was born and what the entrepreneurial story behind it. I'm gonna leave the stage in a second. I will be here at the end, happy to answer any question. I'll be here for the Q&A, and I'll be here also at the end in case you want to approach me and you have a specific question, okay? So thank you so much for coming tonight. I'll leave it to Marcella to walk you through the market outlook.
Hi, good evening, everyone, and thanks so much for having me, StashAway. I'm a JP Morgan representative. JP Morgan Asset Management. I'm a global market strategist. I'm Marcella. I've been with JP Morgan for around 7 to 8 years, and I'm so delighted to be here. So first of all, Happy New Year. And secondly, just a brief, quick outlook for what I'm going to talk about in the next 15 or 20 minutes of your time. I'm just going to talk about what we view for the global economic outlook for the first part, and how the Fed will decide on the rate cutting cycle going forward, and what's our view on that, and how that will impact on your potential investment allocation and portfolio allocation for the rest of this year. So first of all, I guess with global market outlook, especially when we speak to Asian clients or Hong Kong clients, all they mostly care about is about US. And in US, right now, we believe it might differ from what Stephanie's view, but we can discuss more in depth later in the fireside chat. Right now, we do believe that soft landing should be achievable. So what exactly is soft landing? It seems like the buzzword lately with US economy, because in 2023, when we came out to talk to clients were worried about developed market recession, but right now, soft landing seems achievable. Well, soft landing suggests that inflation should be able to come down moderately, and we do expect that inflation should be able to reach the 2% target by the end of this year. Meanwhile, economic growth momentum is going to decelerate globally and also within US economy, but then it's going to decelerate to around trend growth. So from this side, on the right-hand side, we believe it's going to reach to around 2% growth. And in 2023, we see the major economic contributors within US economy was mainly investment and consumption. So what has happened so far? We see that indeed retail sales and, for example, credit card delinquencies has been slowing down a little bit, with retail sales having the boost from the pandemic funds, etc. And there was a boost in 2020 right after the pandemic started. And it has actually decelerated a little bit. And credit card delinquency, especially the share of loans in early delinquency, has also gradually climbed up. But this is majorly fallen into lower income group. And overall, actually, the household debt remains within desirable range, and also the bankruptcy rates, and also the bank loans, or actually others overall, as actually still manageable. So we do see risks in terms of the lower income group, but then overall we still see green shoots on that end. And on the capital investment spending side, throughout 2023, we see different support from the government. For example, different acts that were sponsored. For example, the Jobs Act, the Jumpstart of Own Businesses to support new businesses. And also, for example, different Inflation Reduction Act to support green economic sectors. And also the Semiconductor Supporting Act, so to support domestic production and also research of semiconductors. And this has indeed driven up capital investment in 2023, especially for private investment in US economy. And we do see the risk of the fiscal impulse slowing down in 2024, especially as election year coming, and also the risk of US government shutdown re-emerging again. Yes, it happened several times in 2023, and it is possibly happening a few more times here in 2024. And for US government election happening in November, right now after the Iowa caucus, we do see potentially the re-emergence of the battle between like Biden and also Trump. More likely, we believe it's going to be divided government outcome. It's still too early to say, but then it suggests that the fiscal impulse for the rest of this year will be relatively low. And also the support from government and also in terms of investment spending will also decelerate compared to 2023. But then we believe that given US economy should be able to achieve soft landing, that suggests that eventually we believe that the investment confidence will gradually pick up towards the rest of this year. And the two concerns for the Federal Reserve, for the central bank, on the one end is growth. And so we believe it's going to be trend growth around 2%. And then the other aspect that they have been worried about since 2022, 2021 has been inflation. And the good news is that inflation has been slowing down. Yes, you might argue that the CPI report last week suggests that inflation is still quite resilient, especially the shelter inflation. But then the more in-time data, for example, the Zillow Rent Index suggests that inflation, especially the shelter or rent inflation, is indeed slowing down. So we do suggest that, believe that towards the end of 2024, the numbers should be able to gradually climb down. But admittedly, there's the risk of, for example, different supply chain disruptions happening that might push up oil prices and also food prices. So that's a risk that we continue to monitor. But so far, we believe those risks might be quite temporary and would not deter Fed from cutting rates possibly from the middle of this year. So in terms of political calendar, I was just talking about how this year, actually, other than US election, over half of the global GDP will be entering into elections. So this is a key elections year, and there will be a lot of political uncertainty. But when we talk to clients, when we elaborate to clients, we suggest that election might cause political uncertainty before and after the respective country elections, but then what investors should concentrate and focus on as the economic fundamentals. And so there might be some volatility happening, but then economic fundamentals will still be the key when you make your investment decisions. So especially when we look into US government or US economic performance, we see that given how we're expecting a divided government, which will be the gray bars, we see that GDP in the past, since 1947, the average has been around trend growth, which is what we're expecting, around 2.7%. And then for the S&P 500, we see that the return for divided government is also around 8%, so it's quite decent performance. And this suggests that investors might be deterred or affected or swayed by political noises. Eventually, focusing on economic fundamentals when you make your investment decisions remains key. And given how, an economic sense, we expect that the US economy, from consumption aspect, investment aspect, and inflation aspect, we do expect a slowing down in global economic momentum, but inflation should be able to get to 2% target, even though we do concur that they should start cutting rates and in 2024. But then March cut right now, even after last week's data, the probability that market is pricing in still remains at close to 60%, which we believe is a bit too aggressive. So that's why we believe it's still a bit hard to argue for a March cut. We do believe they are going to embark on a rate cut cycle, especially after how dovish they have been in the recent December Fed meeting. But then we expect them to actually start cutting probably in June, and then another one probably in September and December. So we're expecting 3 rate cuts in line with what the Fed is expecting, instead of what the rate market is expecting, a recession outlook of around 5 to 6 rate cuts. So right now we expect our market to slowly possibly price out the March rate cut and gradually extend the rate cut decision towards the middle of this year, or even further behind, as the data continues to suggest that the US economy remains quite resilient. And a lot of clients might question about how should I design my portfolio, my investment allocation, given we are now end of the rate hike cycle, and as we embark on the rate cutting cycle. This is one of our key charts from our Guide to the Markets, which I forgot to advertise. It's our flagship publication that we actually publish every quarter, and it shows different slides, different charts of key economic signals that clients or you guys can pay attention to. And one key point is we have now also started doing it on a daily basis for key data points that you might be interested in. So this is one publication, and this is one key slide that a lot of investors like. On the left, we see that this is what the 12 months return, asset class return, after the previous 5 rate cycles end. So this elaborates what happened as the rate hike cycles comes to an end. So just recap, the last rate hike happened in July last year. So we are like right in the middle of that 12 months return period. So this will be a good benchmark. So we see that if we neglect blue dots, which is the blue diamonds, which happened with the recession, the dot-com bust, we see that overall both equities and fixed income actually outperform. Compared to a lot of clients here in particular might be saying, oh, I've been putting a lot of my cash into fixed deposit. There's a safer bet, and given the market volatility and also the attractive rates, etc. But if you look at this chart, you see that both equities and fixed income outperform that of cash. Cash is in the others category on the most left-hand sidebar with a very slim positive return. While equities, you see that especially like Asia high dividend equities, they have a very robust double-digit return in the past cycles when rate hike ended. And especially also when given how fixed income in the period when people are worried about the economic outlook and worried about recession, that's when fixed income come into focus and come into favor. And we see that in the fixed income world, we see, for example, emerging market debt and also both US IG and high yield also outperform. And on the right, it illustrates what happened after the rate cut cycle in the past 5 cycles happened. So this actually depends on how we perceive the economy or economic outcome will be. So, and if indeed it's there will be a recession, or like in 2021, in 2001, and also 2007, or if there's a global growth fears, then admittedly equities might underperform. But right now we're expecting a soft landing scenario, which is more like a dark blue diamond. So on the right, you see that equities actually, especially like DM, growth and value actually perform quite decently. And also similarly, the high yield and also emerging market debt, which are also gonna perform in decent over 20% return. And similarly to what happened when the rate hike cycles end, we see that cash once again actually underperform. So this actually materialized in this quilt chart that we love showing to clients as well. If you look at 2023, which is in this whole colorful quilt chart, the second bar from the right, when a lot of clients save into fixed deposit or try to get the high rates from cash, actually you see that in 2023 or just in the fourth quarter, cash underperformed out of all the asset classes. And if with a diversified portfolio around 60% cash, 60% equities, and 40% bonds, we see that diversified portfolio actually outperformed that of cash in both 2023 as a whole and also in the fourth quarter lately. This suggests that having a diversified portfolio of equal weightings or up to your preference of equity and fixed income continues to be the optimal asset allocation preference. And given how we expect the Fed to embark on the rate hike cycle starting June this year, we decide that we see that earnings will likely be re-rated, especially for growthy sectors. So on the right, we see that the bottom parts suggest the sectors or styles that tend to outperform when yields are falling. And when yields are falling, we see that the growth and also, for example, tech and also communication services tend to outperform. So these are the sectors that we tend to prefer as the Fed embark on the rate cut cycle. And other than the tech and the growthy sectors that will potentially get earnings re-rating, we also continue to favor Asian equities. Given how, as the Fed embark on the rate cutting cycle, the potential for US dollar to fall might attract capital inflows back into Asia. Asia has been a relatively unfavored region in the past year or so, but we believe the upside potential remains great, especially how we see at the current price to book ratio at 1.6 times, the return in the next 12 months tends to be quite decent and positive. And on the right, we see that as US dollar potentially falls further, that will actually attract more capital inflow into Asia and causing outperformance of Asia Pacific equities compared to MSCI World, the developed market performance. So given how the current, in terms of absolute and also relative valuations are quite attractive, and also potential for US dollar to fall, we see the potential for Asia equities to outperform in the coming year. And in terms of Asian equities, we actually see two key supporting macro factors. On the left, we see that actually, given the potential of US economy slowing for the rest of this year, domestic demand is actually quite resilient within Asia. And over 75% of revenues within Asian corporates actually supported by domestic demand. So even with US economy slowing or developed markets slowing with the exports or potential trade coming down, we still have supported by domestic demand and also tourism, for example, in ASEAN regions. And on the right, we also see that exports are closely correlated to the earnings performance in Asia. And in the past few months, we see actually Taiwan and also Korea exports continue to outperform, and also with the tech inventory, the stocking pressure easing, and also the AI hype continue to penetrate into more applications and appliances. We believe this will also contribute and provide support to Asian exports for the rest of 2024. And as I alluded just now, we see that on the left is how Asia 5, which includes Korea, Japan, Singapore, Taiwan, and Thailand. And in the past year or so, we see that actually tech exports continue to surpass that of overall and also non-tech exports. And given supported by also the artificial intelligence supportive factors, and also of other technological advancements that we continue to see as key catalysts for the rest of 2024. And this on the right illustrates what I was talking about with the inventory destocking pressure coming down. And so shipments continue to build, and this should be quite supportive for both Korea and Taiwan exports. And in terms of dividend, as the rate cut cycle starts, we believe the interest or the attractiveness of dividend will likely return. And dividend is actually a key part of Asian equities. If we look on the right-hand side, we see that since 2000, actually dividend yield, the blue color shaded areas, contributes close to 60% of Asia Pacific equities contribution. So going forward, we continue to see as the attractiveness with the rates coming down, the attractiveness of dividend yield will continue to grow. And on the left, we also compare, if you look at focusing on the high-diff Asian Pacific equities compared to the light blue diamond, which is the Asia Pacific equities, we see that compared to the benchmark, the headline index, the high dividend equity index actually has lower volatility, given that how it's going towards the left top tier, while the return is actually relatively more. And also the dividend yield, the APAC inside the box, we see that the broad index is giving out around 2.9% dividend, where actually high dividend index is giving out 6.1%, a very attractive yield level. So with the attractiveness of, for example, fixed deposits coming down, as the rates continue to come down or decline, this suggests the attractiveness of dividend, and also dividend investing within Asia will continue to grow. And switching the gear from equities to fixed income, if we look at this bars, we see that actually right now the valuations are quite expensive, quite rich in terms of the fixed income. And with the fixed income world, they actually, with the spreads this tight, is actually pricing in a close to perfect world, which we are quite positive about economic outlook in US with a soft landing. It's not too positive to that extent. So we do expect that the spreads may widen as some of the negative news continue to come in and may affect the market performance. But then we believe that with the yields, investors will continue to should lock in at the current high yields. And also as the interest rates come down, the price return will still be attractive. And that's why at the current juncture, we see that if clients are worried about recession risk, then investment grade bond might be a more resilient selection or choice for the portfolio construction, while high yield bonds, given the attractiveness and also the quite robust fundamentals, that will be the way to go for those that are more risk-taking and also consider income as a more key component of their portfolio. And so just hopefully in the past 15 to 20 minutes, I managed to give you a brief tour around the world. And we see that there are a few signs of the U.S. economy falling off the cliff. So we believe that soft landing should be achievable. And as I was saying, how we believe that the Fed will likely be embarking on the rate cut cycle possibly from June onwards. So there will be lower bond yields over the next 6 to 12 months. And U.S. dollar might weaken, and this should attract capital inflow into Asia. And investors' interest into Asia will come back into favor. And equities, we believe that should favor growthy sectors like tech, and also Asian equities will benefit from, for example, the cheap and demanding valuations, and also on the macro supportive factors. And investing in an election year, the key is to not be swayed by political noise and focus more on economic fundamentals. I'm happy to discuss more during the fireside chat, and hope you find this insightful. Thank you so much.
Well, thank you very much for that, and I very much enjoyed the presentation. It's a lot to digest. So here is another 20 minutes of more to digest for you guys. Yesterday, I did exactly the same market outlook for our clients. How did I click? You need to change presentation. Okay, so last night I did an outlook session for our clients. I tried to control it under 50 minutes, which I miserably failed. But tonight I only have 20 minutes, so I tried to kind of wrap it up as quickly as possible, but try to explain the key points so that everybody can understand. I may go, for some charts, I may go a little bit faster, but don't worry. If you have questions, we're all here to answer your questions. I think our Outlook session was also uploaded online, so you can always check it out. As always, our communications are all free on our website. So, for example, on a monthly basis, we put out StashAway Insights, which all of you can check out, and those actually represent some of the thinking that we've done with myself and my investment team. So on to the meat of our presentation tonight. Our 2024 outlook, I've titled it A Matter of When, Not If. We'll kind of find out why. But for tonight, we're going to have a three-part presentation. First of all, we're just trying to do a quick 2023 recap and also take a look at how StashAway portfolios have done. Secondly, we'll go on to the macro outlook and also some regional themes that we think could be interesting to our investors. And then lastly, we're going to talk about how do you position your portfolio given all these things that we're talking about. So first of all, without further ado, 2023. It was actually a pretty interesting year. Now, of course, that followed a very bad year in 2022. Here is a chart that shows you equity returns and bond returns going back all the way to 1988. And you can see actually a few things. Number one is that on average, equities and bonds return both positively. Equities on average, global equities on average return about 9%. Global bonds on average actually return 4.7%. Now, of course, there were some years when things went negative. And 2022 was unique in a sense that both equities and bonds were down 18%. So it was actually a very, very difficult year for markets. Now in 2023, equities saw a big rebound of 23%. However, bonds is still in the red with a rebound of only 5.2%. So it seems to be a pretty good year for equities, right? It was up almost over 20%. However, if we replay what has happened, a lot has actually been happening in markets, which shook a lot of investors. Just a quick recap. In the first quarter, we had the scare of Silicon Valley Bank going bankrupt and also affecting the US banking system. Now, of course, the Fed came out very quickly to backstop that. Afterwards, we had the AI boom, the Magnificent Seven, NVIDIA, etc. During the summer, there was a scare that the interest rates are going to be going much higher, given both a more kind of hawkish Fed and also the fact that markets is getting worried about US issuance of debt. But boom, in the fourth quarter, everything rallied on the back of kind of expectations of lower interest rates. And that wraps up the year. StashAway portfolios actually performed decently well during the year. So on average, we posted returns of 12% in 2023. Now we have different risk benchmarks. For the high risk benchmarks, for the high risk portfolios, we return higher, and vice versa for the lower risk portfolios. However, it is interesting or important to know that compared to our same risk benchmarks, during this difficult time, we actually control risk better. So this is a chart that shows you two lines. The darker blue line is an average of StashAway managed portfolios, and the dashed line is the same risk benchmark average. Now, 2022 was a difficult year in which both portfolios and the benchmark saw drawdowns. However, the StashAway drawdowns were much lower than the benchmark average, and therefore it allows us to outperform during the whole period. So, in a wrap up, if I think back like 12 months ago, same event, everybody was talking about recession. It was like how bad the recession is going to be. Now, of course, in retrospect, the recession actually never came. This is a chart of Google search on the word recession. In the beginning of the year, the index was 80. Now it's come down quite a bit. So now nobody is talking about the recession. So actually what happened? Why did the most anticipated recession never came? I just wanted to showcase an art piece that I did on Midjourney. AI was obviously a factor. I don't know how many of you have tried it. It's awesome. So if you haven't tried using AI in your everyday work or generation of prompts and everything, go try it out. But this is original artwork by my partnership with the AI. So going back to why a recession didn't happen, first and foremost, and most importantly, actually the US consumer was very, very strong. And the US consumer spent on services, which was actually still rebounding from a COVID slump. This chart shows you the US service consumption going back all the way to 1985. And I actually drew a trend line here because the growth has actually been quite consistent. So on average, on an annual basis, US consumer spending on services have been growing at 3%. And that was also the case last year. Now you see a big kind of blip inside of kind of the right-hand side of the chart. That was COVID, because people are locked down at home. You can't go out. You can't go to restaurants. You can't spend on travel, etc. So we're actually just recovering from that, and that is still growing at a 3% pace, and that supported US growth. And as Marcella mentioned, the reason why we focus on the US is because it drives a lot of the economic activities, not just in the US, but globally. And what about rate hikes? Showcasing my original piece of art. So there was a historical rate hike in terms of the pace at which and the aggressiveness at which the Fed actually hiked interest rates. Here is a chart of all the historical rate hikes, and the recent cycle is actually shown in yellow. Now, the steeper the slope goes, the faster the rate hike cycle was. So as you can see, there was only 3 other rate hike cycles that were faster than what we've experienced in 2022 to 23. Those were all in the 70s, 73, 74, 80s. I mean, those were very, very high inflation periods where the Fed had to take interest rates north of 10%. And every other cycle since have seen a shallower increase in interest rates. Now, given this increase in interest rates, the natural question to ask is, why didn't it filter through? Why did it trigger like a much bigger problem? So we looked at both the consumer and corporates. And what we realized is that, number one, for consumers, they're actually not taking on extra burden. Because, for example, one of the major expenses that households have is mortgage. And a lot of these mortgage were actually locked in a few years earlier when interest rates were super low. So this chart actually shows you the household debt service ratio in the US, meaning that if I earn $100, how much am I going to spend on repaying debts and also repaying the interest rates? Now, the top line is the total spending. Yellow line is spending on mortgage-related debt servicing. As you can see here, again, there's no significant pickup. So the debt service ratio, it's pretty stable at 10%. Now, it went down post-COVID because of government stimulus checks and everything, but it's bounced back to just a very, very normal level. So nothing wrong here. And actually, when you look at US corporates, interestingly, US corporates actually benefited from the interest rate increase. Now, that is a bit counterintuitive, but if you think about some of the largest corporates in America, they actually borrow money in the long term. So a few years ago, when interest rates were very low, they lock in sort of loans at 5 years, 7 years, or 10 years. But they have a lot of cash on the balance sheets. They're not investing because they're all very cautious about the economy. So these cash sitting in the bank is now earning north of 5%. So in fact, the US corporates actually saved over $90 billion in terms of interest expense. And these goes to supporting equity prices and valuations, et cetera, et cetera. So when we look back, actually, I mean, the higher interest rate didn't filter through. There's a caveat to this though. The longer interest rates actually stay at high level, the more likely it's going to start flowing through to the economy. So that is a caveat. Now, going to part B, the more interesting part, after we kind of take a look at what happened, what's going to happen next. And here, I actually want some participation. Since, I mean, you guys have been sitting here for so long, we just like kind of do a bit of a poll. So very, very simple, yes and no questions. I'm going to ask a question, and if you agree with the yes or no, just put up your hands. If you don't know, feel free to like just leave it. Don't put up your hand, but I would encourage everyone just to try. There's no right or wrong answer. I'm going to put up my hand as well. Actually, no, I'm going to put up my hand at the very end, but I'm not going to influence the answers here. So first question is, will US enter a recession? So who thinks that the US will actually enter a recession this year, let's say 2024? Put up your hand. All right, I see a few hands. So it seems like people are agreeing to the JP Morgan view, like no recession, soft landing. All right? Yes, exactly. So second question, will the Fed start to cut interest rates this year? Whoever thinks that it will, please put up your hand as well. All right, we have more hands. So I think roughly half-half. So half of people think they'll cut, half of the people they'll stay put. Now the last question, I said I'm going to put up my hand for this as well. Question is now a good time to invest? I'm going to be the first one to put up my hand. And I see roughly half-half as well. Yeah. All right. So we'll talk about why. So I guess, yeah, before I answer the question of why I think now is a good time to invest, let me just give you a bit of a flavor of how we think about investments at StashAway. We actually follow a systematic framework or kind of algorithm when we do our asset allocation. So as Michele briefly mentioned, the majority of our customers actually invest in our globally diversified asset allocation portfolios, which are invested in equities, bonds, other assets, gold, commodities, etc., across different markets and sectors. And the way we decide how we allocate these different asset classes in a portfolio is by using something called ERA, ERAA, Economic Regime Asset Allocation Framework. And the concept behind this is fairly straightforward. When we look at how different asset prices or how different assets perform, they actually follow certain patterns. And these patterns are actually dictated by where we are in the economic cycle. And I mean, just as a demonstration, we can think about the economic cycle in 4 quadrants divided by growth and inflation. So let's start from the top left, which is good times. So good times, as the name suggests, is the time when inflation is quite low, but growth is high. And this is when companies actually enjoy the best of all worlds because you're enjoying higher revenue, you don't face the problem of inflation, so your margins can also grow. So that's when equities actually perform the best. Now, as good times go kind of further, the inflation pressure actually starts to build, and that's what we saw in 2022 and or 2021. And that's when we go into an inflationary growth regime. That's when inflation starts to go up, the Fed starts to tighten. Now, returns is still quite good here, so companies can still grow. However, it's not as good as good times. As the Fed continue to tighten monetary policy, continue to raise interest rates, that starts to create problems for the economy. So growth actually starts to slow down. And that's when we go into a stagflation regime, which is what we've entered in December 2022. And we're actually still in that regime, as indicated by our model. We're not yet at recession because inflation is still very high and growth is not yet collapsing. So, I mean, our model actually shows that we have been in stagflation, we have not gone into recession yet. And that's why, that actually drove our asset allocation in the past, like kind of 6-7 years, and also, of course, in the past 12 months. Now, this cycle, we call it a cycle, because when you go into recession, then the Fed starts to lower interest rates and loosen monetary policy. And that's when the economy can recover again and go into good times. So this cycle repeats and repeats and repeats, and that's how we can use data to do a lot of back testing to kind of do our asset allocation. So of course, this is a very simple graphic. I mean, we have more sophisticated algo behind it, but I mean, just for everyone to understand how we think about things. Now, having explained that, so the two axes is inflation and growth. So let's take a look at that. Number one, inflation is coming off from historical highs. This is true for the US and also for Europe. And I mean, this chart, I don't need to go into details. Basically, we were very, very high inflation now coming off. However, still some ways away from the Fed's and ECB's 2% target. On the growth side, the key to understand growth is actually the labor market, and particularly US labor market. Here is a chart of unemployment rate. There's some shadings in red, which represents recessions. Anyway, the key here is that in every recession, they coincide with a very sharp increase in unemployment rate. And as you can see on the the bottom right now, unemployment rate is 3.7%. It's gone up a little bit, but it's still very, 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 very low in a historical standard. One of the reasons labor market is so strong, and we actually had this chart out several months ago, is that when we looked at the impact of COVID on the labor market, it actually had a pretty structural impact of workers leaving the workforce. So this chart actually shows you in the blue line, the US labor force, how many people are working. There was actually a sharp drop during COVID. And the thing is, if you project it forward, this blue line recovers somewhat, but there's still a lot of so-called missing workers. In fact, there's 2 million workers missing. I mean, where all these people go, a lot of them are actually early retirees, that they're unlikely to return to the workforce. And then some of them actually switch from working at a physical location to working from home or different cities. So today, there's still a gap in terms of the workers available in the US, and that actually has kept the labor market much stronger than what a lot of people expected. So it seems like all clear, no recession, soft landing. So yeah, back to the good old days. I didn't generate this because I found a better meme, so I thought this was a better representation. However, we have a slight problem on Apollo 13. The problem is twofold. Number one, a soft landing is a very, very rare occurrence. So here is a chart of kind of the historical periods after the Fed hiked interest rates. The green bar is the only soft landing scenario that we could find in the past sort of 50, 60 years. There were some like softish landings, but a lot of them were actually ended up in hard landings as well. So to achieve soft landing is not impossible, but it requires a lot of stars to align. Right? It requires the Fed cutting at exactly the right time, not to trigger a deeper downturn. The problem is that, I mean, this outcome seems to be quite well priced by the market. at least right now. And here is a chart of the market's expectation of interest rate cuts. And let's not go into details, but the key takeaway is that by the end of 2024, the market is actually expecting the Fed to cut 6.5 times, 163 basis points. That is very, very aggressive by any kind of historical standards. By reference, if you go back to before the financial crisis, 2007, the market was actually not expecting such a drastic cut. So the recent changes in bond yield have been very, very fast and furious, and we think there's a bit of overshoot as well. On the equity side also, we think that a lot of expectations are being priced in the near term. So this chart actually shows you in the blue line, the US PMI or ISM, which is a metric that we like to track. It basically is a leading indicator of economic activity. So when the blue line goes up, it means that things are good, expansion. When the blue line comes down, it means that things are not that great. And the green line is the year-on-year change in the S&P index. So as you can see here, actually the two coincide quite nicely. When things are good, like stock markets rally, vice versa, makes sense. What we can see here is that the stock market is a little bit ahead of the data. So the stock market has already rebounded 20% year on year, which is not kind of correlated with the data. So we think that, even if we get like an uptick in data, it seems like the equity market has sort of preceded that. And there are a few risks, right? I think Marcella mentioned inflation as one of the risks that JP Morgan is monitoring. We're definitely agreeing on that front. We do think that inflation will at some point get down to the Fed's target of 2% or close to there. But the road to that 2% may be bumpier than what the market is pricing in. One of the analysis that we've done and actually looked at is to kind of think about the inflation factors from a demand side perspective versus supply side perspective. Now, what are supply side driven inflation? It's basically, for example, if there is a war and oil becomes a supply constraint that drives up oil prices, that is a supply side inflation. If labor market is constrained, that drives up wage prices, wage growth, that is also supply side problem. And for demand side, it's basically people having money and spending. So the more people spend, the more it drives up prices. And here, the thing that worries us a little bit is that the disinflation or the coming down of the inflation over the past few months have been mostly demand-led. So slowing economy. But the supply side inflation is actually still quite sticky. So with that, we think that if the supply side inflation does not ease, then inflation may actually prove to be stickier than what is expected. And to think about inflation, oil is something that we pay a lot of attention to as well. Now, despite all the talks about technology, ESG, et cetera, actually oil still plays an important part in the economy. And if you look at oil prices in the past decade, you can see that there has been three distinct phases. On the left-hand side is before 2015, when oil prices actually averaged $92. And then starting from 2015, oil prices actually took a step down. And from 2015 to 2020, actually oil prices averaged $50 on average. And that was because of the US shale gas revolution. A lot of gas were pumping out from the US, and that drove oil prices down. Now, post-COVID, we've seen a recovery in oil prices, and the average post-COVID has been $80. So the reason why post-COVID average was a lot higher has been, I think, due to a few reasons. Number one, US shale gas is not growing as quickly as before. Number two, and perhaps a more important reason, is that there is heightened geopolitical risk, and the market is actually paying a premium to these geopolitical conflicts. Starting with Ukraine, now we have some conflicts in the Middle East, so that is supporting oil prices as well. And this is a chart that I find quite curious, and so I decided to throw it in despite it maybe being a bit more technical. So this actually plots the oil prices versus forward expectations on inflation. The yellow line is oil prices, the the white line is forward expectation of inflation in 5 years' time. Now, you may think that if it's forward expectation, why does it correlate so well with what's going on currently? And apparently, market participants likely look at what's happening right now to think about the future. So that's why it's important to pay attention to what's happening in oil prices. And in fact, when the Fed thinks about its monetary policy, the forward expectation is something that they pay close attention to. So we should as well. And then very quickly going into some regional themes, because we do think there are some other very interesting things going on apart from the US. Firstly, just kind of thinking about the big three. By the big three, we were talking about US, Europe, and China, like the biggest like 3 economic blocks. Firstly, on Europe, we see a more severe slowdown in Europe, in European economies. So this chart actually shows you the different PMIs, the leading economic indicators for different countries in Eurozone as well as US and global. Long story short, the redder it gets, the worse it is. Now you can see that Europe is actually getting worse and worse. The US is not getting better, but at least, I mean, it's still kind of white. So on a relative basis, still better placed. China is, it's a difficult story because of the cyclical downturn that it's been experiencing in the last 12 months. And despite a lot of talks about stimulus, I mean, to us, what matters most is not the talks, but actually showing up in the data. And a few indicators that we track very closely is the inflation data, because right now, actually, China is in deflation. And when you think about the 4 quadrants, I mean, China is actually the only major economy that's squarely in a recession quadrant. I guess when we see a turn in these economic indicators, that's when we think actually China would start to attract more investments again. But until now, still, I mean, we're not seeing a turn in the data yet. So what are some of the more interesting themes as investors that you can get into? We think there are some interesting domestic reform and restructuring themes. Japan is, of course, has been like kind of performing very well last year and also beginning of this year, getting a lot of attention. Warren Buffett invested in it. There's a lot of things going on there. However, I pull up this chart because a lot of people ask me, like, it's gone up so much already. Like, is this too late to invest? This is the chart of Nikkei going back all the way to the 1990s. As you can see, Japan had a lost kind of 30 decade. So, I mean, we're just getting back to where it was at the beginning of 1990s. So from a long-term perspective, it's actually still, I mean, not surpassing the high there. And there's a good chance that, I mean, I think there is further upside from here. And it's because Japan ROEs are still very, very low. Return on equities on the companies still ranks very, very low in the global scale. And given a lot of government incentives, corporate incentives, we think that there is chance for Japanese equities to move upwards based on an increase in return on equity. And this is exactly why Warren Buffett is invested in Japanese equities as well. In addition, this year, the government has some reforms to encourage local domestic Japanese to invest in the equity markets by giving them tax incentives. And according to some estimates, there's 14 billion of inflows potentially into the market. As a comparison, last year, there were 30 billion of foreign inflows into Japan. So this domestic inflow is actually quite significant. Now, very quickly going into India. India is another structural story that we like a lot. Again, last year it performed very well. So again, the question of, is it too expensive to invest? But if you lengthen your time horizon, MSCI India has returned 10.5% per year for the last 20 years. And this significantly outperforms the MSCI World Index, which returned 8%. And it even beat our favorite S&P, which returned 10%. So it's not a one-year story, it's not a two-year story, it's a multi-decade story. And we think the story is actually getting better for 2 reasons. Number one, India has been underinvested for many years. If some of you travel to India, you would know that there's a lot to be done on the infrastructure side. And encouragingly, we're starting to see the Indian government spend a lot more on upgrading the infrastructure. In the past 3 years, they've actually almost doubled their investments in these infrastructure upgrades. So we think that's a great change. And then secondly, historically, I guess as foreign investors, you worry about inflation in India because that depreciates the currency. And there's a few reasons for that, but I think one of the key changes that happened in 2015 is that the RBI, the Central Bank of India, started to target inflation. And since then, inflation has actually been stabilizing at around 5% versus the 8% average in the decades prior. So I think, this is a very good development. So I see my colleagues circling me, so I'm sure I'm over time already, but I just wanted to very quickly go through our last part of how do you position your portfolio. So this is a chart I borrowed from JP Morgan. I actually love the JP Morgan research. I'm a big fan of it. And I think given all the things that we talked about, different outcomes, et cetera, it's a great way to think about the outcomes in terms of probabilities. Like, what are the possible scenarios, and how do you position your portfolio in the different scenarios? And of course, this is done using the great JP Morgan engine and a lot of brain and research power, and that's what we're trying to do at StashAway as well. But I think for most investors, it's very complicated. It's probably too complicated for you to think about things in like 5 different scenarios. So what can you do as an investor? Number one, of course, is to entrust your portfolio management to StashAway. So, for example, that's why we have like these globally diversified portfolios that changes according to the economic outcome. This is a sample allocation of one of our kind of medium risk portfolios. As you can see, it has allocations to bonds, equities. We are overweight cash as of today, just because it gives you the best kind of risk reward in terms of the yield that it's generating. So this is my final art piece. It's a crystal ball. The message here is that even though there's all these different scenarios, all these kind of macro potential headwinds or tailwinds, there's one thing that you can be sure of. And that's why I put up my hand and say it's a good time to invest. You can be sure that if you invest in a diversified portfolio, you generate positive returns over time. This is a chart of the 60-40 portfolio, very typical, simple equities and bonds, 60% equity, 40% bonds. You can see it's a line going from bottom left to top right. So it just goes up. Of course, in the short term, there will be fluctuations, particularly, let's say, if we enter a recession. But if you give it enough time, it'll grow. And the reason why it grows is that when you think about long-term returns, it's all based on fundamentals. It's not based on sentiment. It's not based on how different investors feel. I'll just give you an example. This is S&P long-term total returns. So on average, S&P has returned 11% per year. Why do you get 11%? About 5 to 6% of that actually comes from earnings growth of the S&P companies. These companies actually make profits. They grow every year to the tune of 5 to 6%. And then they also do buybacks, 2 to 3%, and they also give out dividends, about 2%. So it's a very simple math, right? It's 5 to 6% plus 2 to 3% plus 2%. There you go, 11%. So it makes fundamental sense. It's not random. It's not like throwing a dart. And if you stay invested for long enough, from compounding at 11.5% per year for the last 40 years, you would have grew an investment 81 times. That's the power of compounding. That's the power of staying in markets for a very long time. So just as a final experiment, I know we're running out of time, but I really like to just do this thought experiment with all of you, is to rewind back in history to 2007. Now imagine that we just gone through the Lehman bankruptcy, the stock market just crashed from 50%, and now we're at this point where it's things are very bad. I remember I was actually working at Goldman at the time, and every day you wake up, a few colleagues gone. So we were in that kind of environment. Now you ask yourself, would you actually invest here? Probably very, very hard, right? Because you see the world collapsing around you. But then the Fed actually came out with the QE program, and boom, everything just went up again. Now you may be asking yourself, or kicking yourself not having invested in the most difficult days of the financial crisis. However, now it's even more difficult to make that investment decision because you're thinking, oh, actually, I mean, the world is not improving that much. Now it's already too late. Things have rallied. So you think to yourself, okay, if the market actually corrects about 20%, let's say it goes back to the middle of like the rally, I'll add back, I'll just start investing. So you have a plan and you plan to execute it. A few months later, the market seems to be wobbly and it starts to like kind of come off. For some of the technicians out there in the crowd, this is like a typical head and shoulder. Seems like it's piercing the shoulder, whatever. So you think, okay, I'm getting my cash ready, I'm gonna invest. And then boom, things start to rally again. So you sort of miss like all the chances that you could have invested in the stock market at the time. This is not a problem. The problem is that if you zoom out for another 10 years, 15 years, you would have lost the whole bull market of 12% growth per annum. And if you just kind of zoom out to the big picture, the Lehman Brothers bankruptcy and everything that happened during the financial crisis was just a blip in a graph. So it shows you the power of time, of staying invested, rather than timing the market. Now, I know psychologically it's very, very hard to do, but the good news is that there are tools that can help you to overcome this psychological barrier. It's actually my favorite. It's called the dollar cost averaging, short term for DCA. So you can actually, I mean, this is what I do, like Michele and a lot of my colleagues do as well. We set up like a monthly plan. So a lot of us have like a regular income, regular kind of employment. You set up a monthly plan. Every month you start investing in a portfolio. So every month you put in a fixed amount. It's like savings, but saving into investments, which is even better because investments actually over time give you much higher return than savings. So make use of dollar cost averaging instead of trying to time the market because that takes off a lot of cognitive load from investing. And I mean, just as a final kind of data to show you, this chart shows you the return of two scenarios. The first scenario is that you have perfect timing, and you every year you invest at the trough. The second scenario is that you have the worst timing. Every year you invest at peak, and the difference that you get in return is actually not that difference. A difference of 3.6 times versus 2.7 times. So, I mean, what matters is that you start investing. And also, another data point is that if you stay out of market, even just for a few days, it can cost you a lot. Because, I mean, if you miss the 40 best days in the last 20 years, your returns would have been 87% lower than if you have stayed invested for the full period. So think about the risk reward of trying to time the market. Okay, I'm done. So here's some key takeaways. So first of all, StashAway's general investing portfolios posted solid performance in 2023. We were up almost 12% on average. Our ERA investment framework still puts us in a stagflationary economic regime. The market is actually looking for a soft landing. I mean, we're not rolling that out, but all we're trying to point out is that number one, it's a very hard thing to do. Number two, it seems to be quite well priced in. Number four, the US is still best positioned among the big three. Fourthly, focus on domestic structural stories, including Japan and India. And lastly, most importantly, when investing, what's important is your time in the market and not timing the market. So with that, I'll pass the mic to Ronald. Thank you.
So before the Q&A sections, we'll just do a 3-minute quick overview of what actually we do and what we offer in Hong Kong. So at StashAway, our inspiration is to be our client's personal financial secretary, aligned with the philosophy of our advisor in Hong Kong, Mr. John Zhang. We want to provide a simple, accessible way for everyone to invest intelligently. So what does it mean in practice? Starting from simplicity, it's actually everything that we care or everything we do, right? Our digital-first approach allows everyone to seamlessly sign up, create a portfolio, manage your portfolios in an app. And also with an in-person CX team in Hong Kong. So basically, we're just a call or text away if any question along the journey. Moving on to intelligence, we offer institutional level asset allocations, but not security selections to our retail investor. Our technologies and algorithms empower automatic rebalancing and also automatic re-optimization. As a client, you can start with any amount. Start from like $10, you can get a very well-diversified portfolio and with low lockup. Our fee is as low as 0.2%, and that's all. We have no withdrawal, no subscription fee. So it's a significant reduction compared to fee charged by mutual fund products. For example, like 2 to 4% simply. And lastly, and most importantly, we're SEC licensed, and our client money is safely held in a custodian account with Citi and HSBC. So here are some screenshots of our app. You can see that it's actually very user-friendly. You can also sign up, see your projections, create a portfolio, manage your portfolio, make deposit withdrawal so simply in your app. And most importantly, you can do DCA. It's a very simple tool for you to set up DCA plan, and that's what I do as well. In Hong Kong, we have a very simple but full suite of product to meet our customer needs, ranging from cash management, diversified portfolio, thematic investing, to even alternative for professional investor. Starting from cash, we actually cash management offering US dollar cash yield actually provide 5.3 to 5.2% yield for now. So it invests in short-term US treasuries with low lockup and minimum amount. So it's a great option for people who want to pack and manage your idle cash. Our flagship general investing portfolios offer globally diversified multi-asset ETF portfolio for a client that are tailored to your risk profile. We have two portfolios, one managed by our investment team, Stephanie, and one managed by our partner, BlackRock. Both offer institutional-grade asset allocations and with automatic rebalancing and re-optimizations. For the StashAway one, we have a proprietary algorithm era that we optimize the portfolio based on economic regime. So we always tell our client, GI general investing is a great foundation of your investment portfolio, an all-weather portfolio. For people who want a more hands-on approach, you can also use our flexible portfolio, where actually you can create your own portfolio with a selection of more than 60 asset class. And each asset class is actually represented by the best ETF chosen by our investment team. You can start from scratch. You can also start from a professionally curated template, and you can also adjust your allocation anytime you want. And lastly, StashAway Reserve. It's actually our first time to publicly announce it. We are rolling out new value propositions and product offering for premium clients in Hong Kong. As a StashAway Reserve client, you will get a dedicated wealth advisor and to receive unbiased financial advice, not only for your StashAway portfolio, but also for a portfolio outside of StashAway. If you're also a professional investor based on SFC requirement, you can have access to private market investment products at a much lower barrier, much lower minimum and fee than what you can get from private banks. So this is a really quick overview of what we do, what we offer in Hong Kong, actually across the regions. I do personally encourage us to explore more about us for our app, for our website, and stay tuned to our future events and also an article that we wrote. So we'll pass it to Tiffany for the Q&A sections.
Thank you, Michele, Ronald, Stephanie, and Marcella. So now let's move on to the Q&A session. Okay, so remember that you have the option to upvote the question. So if there's any question that you like, please click the like button and we'll get to those questions quicker. Okay, first first question, what are you personally invested in? So I guess we can have each of the speakers to share a little bit of your own insights.
I can start. I like this question. So, I mean, first of all, in terms of how I invest, all of my money is invested with StashAway, with the exception of a small apartment I own in Melbourne. Of the money invested with StashAway, I actually have a bunch of portfolios because I like to earmark portfolios for usage. So, for instance, I have 3 kids, so I have 3 portfolios, one per kid called, Matteo University Fund, Agnese University Fund, Luce's University Fund, because it kind of gives meaning to the money, and I like it. And I have, a retirement portfolio, etc. So what I invest in diversified portfolios. I have some US dollar cash that I keep in the US dollar cash yield, and I'm dollar cost averaging every 2 weeks. So I have a bit too much cash right now, and so what I'm doing is I'm dollar cost averaging every 2 weeks into the markets. Yeah, that's it. I'm actually just investing in diversified portfolios.
I actually agree. I also have a diversified portfolio, but actually I adjusted it a bit lately given how in 2023 I have a bit more focus on fixed income. But gradually in recent days, we actually see the attractiveness of equities coming back. So in 2023, we have a bit more focus on possibly maybe 70% on fixed income and 30% on equities. But now we kind of in my personal portfolio also adjusted more to like 50% equities. And actually with the focus back into Asia, we also, especially myself, look more into maybe other thematic stories like Japan and India. India, I agree, like earnings are a bit tough, and it might still take a few years, or near term there might be some corrections. But I think for structural stories, I think it will still play out. And Japan, especially with the whole Nissan story, we do believe that that might be beneficial. So domestically, within Asia, I quite like Japan and India lately.
I guess, for myself, my money is where my mouth is. So whatever I said, it basically represents also kind of how I position my personal portfolio as well. I think one of the most important thing of being an investor is to ask yourself what kind of risk you can actually take, and that depends on, number one, your risk appetite. What volatility can you withstand to sleep at night, and also secondly, what is the time horizon that you're thinking about. So for me, I foresee myself working for a very long time. I actually love my job, so I'm not retiring anytime soon. So my risk appetite is actually relatively high, which is why my allocation could be different from yours. But for me, I'm kind of 70-80% or so in equities. Now that includes public equity and also some private equity investments that I do. But it reflects me as a more aggressive investor. So again, that's why we have StashAway, because we actually help you to assess what kind of risk appetite and what kind of risk is appropriate for you. So that actually is very, very personal kind of allocation decision.
I actually used to trade a lot, right? But gradually I find it doesn't work for me, right, financially. So I make sure that a portion of my salary, make sure a more long-term time frame, diversified portfolio, a fixed amount of my salary, a fixed proportion of my salary. So make sure my investment foundation is solid. And then I may have a little portion of my money to have more more interesting trading game, or for example into Japan, into equities, or into single stock, right? But at least every month I make sure a certain percentage of my salary is getting into diversified portfolio for my longer term, right? Like buying a flat for my retirement, I make sure it's actually kind of solid.
Thank you all. And we have the second question, which is quite popular. Are you going to offer access to a Bitcoin ETF? And I think we can have Stephanie answer that. Thank you.
Yeah, thanks. That's a topic du jour. I'm getting this question every day. So long as the short, number one, we actually do have Bitcoin ETFs on our platform. Unfortunately, it's just offered to Singaporean accredited investor as an add-on to a globally diversified portfolio. So for that particular product, we have actually a box where you can check, I want to allocate up to, let's say, 5% of my allocation to a physically backed Bitcoin ETF. Having said that, of course, we pay a lot of attention to what's going on in the industry as well, and we've actually taken a closer look at the ETFs that are launching in the US. I mean, of course, there's 11 of them that are launching. However, not all of them are equal. And my guess is that most of the fund flows will actually consolidate towards maybe a few of them. And when we evaluate ETFs, there are a few criteria that we look at. And we actually have a scoring system for all our ETFs that we put on our platform. But briefly speaking, number one is the liquidity of the particular ETF. Number two is the cost effectiveness of that ETF. And then thirdly, the track record and also the credibility of the issuer. So all these important decisions actually go into how we select a particular ETF. And for Bitcoin itself, I mean, we think that there are actually one or two very, very interesting ETFs that are worth considering. I won't name names, but we'll make the changes on the StashAway platform as these things mature.
Thank you, Steph. Thank you, Stephanie. Another question for Steph. Is it a good time to invest long-term in China and Hong Kong, given today it's the lowest point in Hong Kong? And I think Marcella can also add your
Maybe I'll let Marcella comment first.
It has been an unfortunate few years or so, and we actually also get the China data today. We see it as a mixed macro outlook, but we actually see signs of stabilization. In terms of China, I think we're still lacking the spark, and confidence is still low. So that's why right now the confidence for both investors, for private businesses, remains at very subdued level. We have been talking or arguing about how Hong Kong and also China valuations are very attractive and undemanding. But one green shoot or one silver lining is that given the current low valuation, or if we look at the price to book, at the current level, for example, with Hong Kong is like 0.9 times. According to analysis, the next 12 months return is an average of 12%, given an analysis of the past 10 years. So it's just like what Stephanie said, you can never really time the market. I think we will always stay diversified, and I think currently we continue to stay bullish or constructive about the long-term structural themes in China. But I think we're still waiting for the positive catalyst. I believe for China, especially the next positive potential catalyst might be the March National People's Congress meeting, where there might be further stimulus measures. But so far, the pace and actually the magnitude continue to be underwhelming. So we're hoping for more, and that should hopefully trigger a turnaround.
Yeah, I mean, I think those are all great points. I'll just maybe add a few. Number one is that today is lower is never a good reason for buying something. Just because today is lower, it doesn't mean that tomorrow can't be lower. But I think when we think about China, as I mentioned, it's going through a very difficult kind of cyclical downturn, in addition to some structural issues that China is actually trying to resolve. So we actually put out a Seattle Insight piece a few months ago, looking very, very closely at China. And we came away with a few conclusions. Number one is that because of the clamp down on a few very important sectors like property, internet, these actually make up significant kind of portion of China growth. And although there are pockets of growth, for example, EV, new energy, I mean, these are still relatively quite small. So in the short term, it's very hard for these newer industries to replace the growth that we've seen in these bigger sectors. So these are the most structural issues that China face, of course, on top of the cyclical issues of slowing economy, and particularly because, I mean, the industrial sector is not growing. So China is actually still very much affected by that. Having said that, of course, valuation is quite low. So in our portfolio, we actually have a market weight on China. We would love to go overweight at some point, but we're not seeing that data yet.
If I can add something from more of a personal investor perspective for a second, I think the key word here is long. The question is not there anymore, but it was long term. And so personally, for instance, I mentioned earlier I have a bunch of portfolios. I actually have a flexible portfolio, which I call China exposure, where I have two ETFs. One is a broad China ETF, and the second one is a China technology ETF. And the reason I have it is that we are market weight on our managed portfolios because the volatility just doesn't make sense right now, and therefore it's in the short term it doesn't make sense. But for me, because I know that that's a small enough portion of my portfolio that I have a very long term horizon for, that I can withstand whatever volatility happens in the next 1, 2, 3, 4, 5 years. And this is, to me, doesn't matter. It's something that I know I can hold forever. I've been dollar cost averaging into the portfolio as markets have been going down. So I've been buying at cheaper and cheaper prices. I'll probably continue to do that, and that just creates an additional exposure to something that I think in the long term will appreciate. I just don't know whether it's going to take 1 year, 5 years, or 10 years, but I don't care. I have that time horizon.
Thank you, Marcella, Stephanie, and Michele. So our next question is, why isn't there any India fund to pick as country as it has great prospect in the next 10 years? And I guess Ronald can briefly walk through the flexible portfolio function. Thank you.
Yes, with a lot of questions, right? So long story short, in the flexible portfolio, you have an India exposure that you can choose. And also in the GI portfolio, I think one is the flexible portfolio, we do have an India ETF for people to choose. And also in the GI portfolio, we do have a pretty decent allocation to India.
Thank you, Ronald. The next question, I guess, is for Michele. How are we doing compared to our competitors, and what's one thing that differentiates us from others? Thank you.
So we've done very well since we launched. I think I shared some numbers earlier. In early 2021, we shared that we passed the $1 billion assets under management mark. We didn't share any numbers since then. So I always joke that the next time we share a number is going to be 10 billion. So we're somewhere between 1 and 10 right now. So we're doing well. We're quite happy. We're the only player that is kind of in more than 2 markets. We're in 5 markets, and we've been growing. We're very happy where we are. So first of all, who are our competitors? To me, our competitors are the banks. So it's money sitting in the banks and doing very little. So there is a lot of money uninvested sitting with the banks, or very badly advised, buying very expensive mutual funds, buying structured notes with crazy risk rewards profile, or buying insurance investment-linked policies with long lockups and incredibly high fees. So that's our competitor. So how do we differentiate against them? In a variety of ways. So it's our value proposition is to make it simple and cost-effective to invest intelligently, and I think we actually differentiate versus the banks on all the 3. So we make it much simpler to invest, we make it way more cost-efficient, and as you probably heard from some of the thoughts that Stephanie shared, we actually the depth of thoughts into creating asset allocation, and the fact the conversation is on asset allocation and it's not on the next product that is fun to talk about today, actually makes the platform way more intelligent. Compared to other similar digital platforms, we differentiate again in a number of ways. One is level of service. So we have a very fast customer support. We have kind of a very high level SLAs in terms of when you want to speak to someone, you can do it very quickly, very easily, and get a response, and you speak to a human being. In addition to that, maybe one differentiation is the way we think about experience. We want the experience to be completely self-service, which means that you can do everything by yourself all the time. You don't need to speak to anyone all the time. But you can speak to someone if you want to. But the goal is to make it your experience. You decide how to manage it. And I think that's a big differentiation. The third point of differentiation is that is the simplicity I talked about earlier. So the experience on StashAway is a curated experience. We are not a fund supermarket. You're not going to find 30 S&P 500 ETFs. Or, for the S&P 500, we do the work of providing the one that we think is best, looking at total cost, looking at liquidity, looking at tracking error, looking at track record of the fund manager, etc. And that enables clients to make faster decision in an easier fashion. And that simplicity is at the core of the way we think about developing the product going forward. So I think those are maybe the main things we think about when we continue to develop the platform in terms of differentiation versus other players.
Thank you, Michele. And I guess we have one last question. As a wealth startup, how did you form the best team and build the best product? Maybe also a question for Michele.
So it's a good question. I think obviously it's been now more than 7 years, so it's been quite a bit of time. But if I think about the early days, which is, you need to start the ball rolling, and then there is a snowball effect if you do the right things, especially on the team side early on. Maybe I share two things. One is you need to keep the bar very high on people. I remember in the early days, sometimes we had a position that we had to fill because it was, the first backend developer. So if you don't have the first backend developer, you cannot develop the backend. And the decision has always been to be patient and wait until we found the right candidate. Even after we saw 40 candidates, we didn't like anyone. We just went for the 41st and then 42nd, and then until we found someone. And I think it's very difficult to do that when you are in a rush to launch a product, you're building, and you need a person. But it's extremely important because the moment you lower the bar, it's a slippery slope from there. Because that person will then be a senior person organization and will hire people. And then the person that this person will hire will not be of the same quality that you wanted earlier. Because, again, there was a former boss of mine in my past life that used to say, AAA people hire AAA people, AA people hire B people, which I think is very true. So keeping the bar high at the beginning is incredibly important. And then I think the second piece is fostering a culture that great talent like to work in. So, the fact that, we are internally, we're extremely transparent, then, we are kind of a fun place to work. I mean, we work hard, but the atmosphere is nice, is relaxed, is collaborative. I think it makes sure that most people like to stay and like to stay for a long time and build careers with the company. And I think that's actually what then matters as you try to build an institution like we are doing.
Thank you, Michele, and thank you all of our speakers for answering the questions.